Everyone's selling you the Bitcoin dream. Turn a few $1,000s into millions, but what they don't tell you about is the millionaire trap, the hidden pitfalls that have wiped out countless investors. They cheer when the price soars past $100,000 and even $125,000, but they go completely silent during the flash crashes that erase billions in a single day. In the next few minutes, I'm going to show you the biggest traps you need to dodge and the overlooked strategies that smart money is using to actually build wealth with Bitcoin. This isn't about hype, it's about survival and strategy. The road to building real wealth with Bitcoin is full of traps that are surprisingly easy to fall into. But the good news, once you see them, you can navigate right around them. Let's break down the biggest mistakes that turn aspiring millionaires into cautionary tales. Trap number one, the get rich quick illusion. The first and most dangerous trap is thinking Bitcoin is a lottery ticket. It's a mindset completely driven by FOMO, the fear of missing out. You see the price exploding, so you jump in with money you can't afford to lose, thinking it's a one way ticket to the moon. This kind of emotional investing is a recipe for disaster. Here's why. Bitcoin is an incredibly volatile asset. Its price swings are legendary, often 3 or 4 times greater than traditional assets like the S&P 500. We saw it plunge from nearly $69,000 in 2021 down to around $16,000 just a year later. And just this month, we watched it surge past a new all-time high of over $125,000 before a sudden crash wiped out billions from the market. When you're in that get rich quick mindset, you buy at the peak of the hype and you panic sell the second the price tumbles. You're playing a losing game against players who have been in this market for years. So, what's the smart strategy? It's a total shift in perspective. Smart investors don't treat Bitcoin like a slot machine. They treat it like a long-term asset. They use a strategy called dollar cost averaging, DCA, which just means investing a fixed amount of money at regular intervals, say $100 every Friday, whether the price is high or low. It takes all the emotion out of the game and builds your position over time at an average price. They have a long term holding strategy, famously known as hodling, and they weather the storms because they have conviction in the asset's future. They're not trying to get rich by next Tuesday, they're aiming to build wealth over the next decade. Trap number two, the myth of easy, anonymous money. The second trap is believing that Bitcoin is simple, anonymous, and that your money is automatically safe on whatever platform you use. This is a very costly mistake. First, let's get one thing straight. Bitcoin isn't anonymous, it's pseudo-anonymous. Every single transaction is recorded on a public ledger, the blockchain that anyone can see. Governments and analytics firms have gotten very good at following the digital breadcrumbs, and they use this to track down illicit funds. Even more important is the security risk. When you buy Bitcoin on an exchange, you're trusting them to keep it safe. But the crypto world is littered with stories of exchanges getting hacked or just completely collapsing, like Mt. Gox or more recently FTX. When that happens, people's life savings can disappear overnight. There's a mantra in this space for a reason. Not your keys, not your coins. If you don't hold the private keys to your Bitcoin in your own wallet, you're just hoping a third party doesn't lose it, freeze it, or go bankrupt. The smart strategy here is to take your security seriously. It means doing your homework. If you're holding a significant amount of Bitcoin, you need to learn about self-custody and hardware wallets. These are devices that keep your private keys completely offline, away from hackers. It's like taking your gold bars out of a stranger's vault and putting them in your own. For smaller amounts or for trading, using a reputable, regulated exchange is fine, but you have to understand the risk. Never, ever leave your life savings on an exchange you don't fully trust. If you're getting value from this and want to keep learning how to invest smarter, do me a quick favor. Hit that like button and subscribe. It tells the algorithm you want more content like this, and it makes sure you won't miss what's coming next. The third trap is thinking the Bitcoin market is a pure free market driven by millions of little guys like us. In reality, it's a playground for giant players, and you have to know the rules of their game. I'm talking about whales and regulators. Whales are people or institutions holding enormous amounts of Bitcoin. With a single massive trade, they can manipulate prices, creating waves that either lift all boats or sink them. They can trigger a sell-off just to buy back cheaper, or create a price surge to lure in retail investors. Then there's the government. Regulatory news is one of the biggest movers of Bitcoin's price. The approval of Bitcoin spot ETFs in the US in 2024 sent the price soaring because it opened the floodgates for institutional money. Conversely, just recently, renewed fears of a trade war triggered a massive liquidation event, where over $19 billion in leveraged positions, bets made with borrowed money, were wiped out in just 24 hours. People who trade with high leverage are the most vulnerable. A simple 10% price drop can completely liquidate a 10x leveraged position. It's gone. The smart strategy is to play defense. Don't use high leverage. Pay attention to the big picture, the macroeconomic climate, but don't make panicked decisions because of one headline. Smart money understands these short term events are mostly just noise. They keep their eyes on the long term fundamentals and don't try to outsmart the whales or predict Washington's next move. Okay, enough about what not to do. Let's flip the script and talk about what smart investors actually do. These are the strategies that separate the successful from the stressed. Overlooked strategy number one, they think in cycles, not days. The biggest mental shift you can make is to stop obsessing over the daily price chart and start thinking in 4 year cycles. Bitcoin's market is heavily influenced by a built in event called the halving, which happens about every 4 years and cuts the new supply of Bitcoin in half. Historically, this supply shock has created predictable, though still volatile, market cycles. You get periods of explosive bull runs followed by long, cold crypto winters. Smart investors don't panic during the winters. They see them as buying opportunities. They zoom out. They know that what looks like a terrifying crash on the daily chart is often just a healthy correction in a much larger uptrend. While everyone else is panic selling, they are patiently sticking to their DCA strategy, knowing the next cycle is likely to bring new all time highs. Overlooked strategy number two, they focus on the digital gold thesis. Why are major institutions and serious investors even bothering with Bitcoin? It's not for a quick flip. They're focused on the digital gold narrative. Here's what that means. Unlike currencies like the US dollar, which can be printed endlessly, Bitcoin has a hard capped supply of 21 million coins. That's it, forever. This makes it a provably scarce asset. In a world where central banks are constantly printing money, potentially devaluing our savings, many see Bitcoin as a long term store of value, a hedge against inflation. Smart investors aren't buying Bitcoin hoping to use it for a cup of coffee. They are allocating a small strategic portion of their portfolio to it, often just 1 to 5%, as a form of digital insurance against the debasement of traditional money. Overlooked strategy number three, they watch the institutional flow. Finally, instead of listening to anonymous influencers on social media, smart investors watch what the largest financial institutions in the world are doing. The approval of spot Bitcoin ETFs in 2024 was a game changer. It allowed massive firms like BlackRock and Fidelity to offer Bitcoin to their clients in a regulated, familiar package. Billions of dollars have since poured into these products, adding a whole new level of legitimacy and liquidity to the market. This institutional adoption is a powerful signal. When you see major corporations adding Bitcoin to their balance sheets or financial giants launching new crypto products, it tells you the asset is maturing. Smart investors use these institutional moves as a guidepost, confirming the long-term thesis that Bitcoin is becoming a permanent part of the global financial system. So, is the Bitcoin millionaire dream a trap? It absolutely is, if you treat it like a get-rich-quick scheme. If you chase the hype, use crazy leverage, and ignore the very real security risks, you're just gambling. And the house usually wins. But it doesn't have to be that way. The dream of building life changing wealth is possible if you approach it like a strategic investor. Avoid the common pitfalls. Adopt the strategies of the smart money. Think in long term cycles, understand the digital gold thesis, and follow the institutional grade signals. Do your own research, only invest what you can truly afford to lose, and build your knowledge patiently. That is how you avoid the trap and start turning Bitcoin's potential into your reality. What are your thoughts on this? Have you ever fallen for one of these traps? Or what's the smartest strategy you've learned on your own Bitcoin journey? Let me know in the comments below. I read every single one. Thanks for watching, and I'll see you in the next video.